Talk about the slightly longer term trends in the equity market. I'm joined this morning by Manishi Raychaudhuri, the Chief Executive Officer of Emmer Capital Partners. Manishi, thanks so much for taking the time. Pleasure having you on the program. Let me start by asking you what your assessment of earnings growth is going to be, because that is going to be the central driving force amidst this elevated uncertainty globally. So we just had a couple of people come through and say that you're likely to see possibly nominal GDP growth being tracked by the top companies, maybe the top 200 companies in India. Do you think that that's going to be the case?
My guess would be that in fiscal 26, earnings growth would possibly be in double digits to early teens. That's marginally higher than nominal GDP growth. I mean, nominal GDP growth for India is currently in the range of maybe 10 to 11% if you have a longer term time horizon. Usually, corporate revenue growth and corporate earnings growth is slightly higher than that. Because GDP growth is, after all, coming from three sectors: agriculture, industry, and services. Agricultural growth is a lot lower than the other two, but the other two, industry and services, the relatively high growth sectors, they are the ones which contribute to corporate revenue growth. Right. So I would think that maybe somewhere around 12 to 14% for fiscal 26. We also have to keep in mind that it's coming up from a low base. Fiscal 25 is hardly about 5 to 6%, which is way lower than the long-term average that India has exhibited over the past several years. So, yeah, in a nutshell, that would possibly be my guess about the medium term.
Manishi, good morning. This is Hiral on this side. That's an interesting take. On a lower base, you're talking about a double-digit mid-teens growth in terms of the earnings. However, if you have to look at the tariff-linked sectors, the global sectors that contribute almost 40 to 45% of your earnings, are you factoring in a risk of downgrades to these sectors as well in terms of the mid-teens estimates? And if yes, is there a possibility for downgrade that could be coming in any of the sectors?
In some of those sectors, yes. In fact, I would rather say that the danger to the export-linked sectors in India comes not from the tariffs, but from the potential slowdown that we could see in the United States. Whether it's going to be a recession or a stagflation, we don't know. But there's almost certainly a degree of hesitancy, a significant degree of hesitancy on the part of corporates to invest or for consumers to consume. In that situation, I would think IT services would possibly have a much bleaker outlook than they have had in the past. And we have partly seen that in the kind of commentary that we saw in week before last from some of the large IT companies. So that is one sector I would be careful about. I'm almost certain that there would be earnings downgrades in that sector. For the others, let's say some of the consumer discretionaries or metals, other materials, which are also globally linked, we would obviously have to watch out for how the bilateral trade negotiations play out. But again, I would be more concerned about how global demand pans out, particularly for materials.
Okay, so let me stretch that a little bit, Manishi, and given the context that you've given us, we've talked about earnings growth expectations. We've talked about what the implications of a slowdown in the US will be. And I think you're focusing on that more, as you pointed out, than the tariff situation, because I don't want to put my, whether you want to put your neck out, but I'm putting my neck out to say that maybe we've heard the worst on the tariff front, right? But having said that, what would you be putting your bets on? Would it be the financial sector? Would it be domestic-focused entities, and what would they be?
I would point out three sectors. Financials, undoubtedly, particularly the private sector banks. Second in line would be industrials. We're likely to see a continuation of infrastructure spend. We would also see an increase in defense spending. We are seeing it all across the world for very unfortunate reasons, and we're likely to see that in India also. I would also point out some of the consumer discretionaries. There's additional money being thrown at the consumers. The most recent tax rebates, now about 12 lakh of income is tax free in India, and that would necessarily translate to better consumer sentiment for discretionaries, not so much for staples, but more for consumer discretionaries. So those are the three sectors in the medium term that I would focus on.
You did mention about consumer discretionary, and that's where I think you've been positive about. I think the last time we spoke to you back then in March as well. But when you're talking to
Right.
companies like a Havells, etc., they are of the
Mm.
opinion that the summer has been delayed. The concern is that demand is muted. Now, if you have to look at this kind of a scenario, in spite of that 1 lakh crore coming in the hands of
Mm.
individuals on the back of the budget, you're not seeing that transition happen into purchases. Would you
Right.
still say that this would be a time to look at consumer discretionary, or would you say that, I mean, on the durable side, or would you say that just stay put for the moment on this sector and wait for things to emerge?
I would think that, for that, economic or fiscal logic to translate into better consumer sentiment, we would have to wait for a few quarters. So maybe in the second half of this fiscal year, we should be seeing that. Right now, there are just too many uncertainties across the world. And we must also not forget that the employment generation situation in India has not really, turned around the corner. I mean, the biggest employment generators were the IT service companies, and there the situation is quite pedestrian, I must say. There are some other areas like the GCCs, the Global Competency Centers, which are doing a lot better, and there's a, likely a skyrocketing expansion likely to happen over there. So it's kind of a mixed bag, but once these two things get sorted out, when the money actually flows into the hands of the consumers, there's also a new pay commission, which would revise the compensation of the government workers. So all this is falling in place together. And when we do have some degree of turnaround in the employment generation situation, that's where we would be able to, sort of hang our hats on the consumer discretionary sector. But I think we should be able to see that in about a couple of quarters from now.
Manishi, how would you play the consumer discretionary then? And would it be, for example, would it be air conditioners? Would it be the allied companies? How would you play it?
Mostly, I would say autos, household goods, and even the value chain, the manufacturers, like the EMS companies, the electronic manufacturing companies. So, I mean, consumer discretionary is obviously a very large sector. I mean, some, analysts, some investors would also include the paints and other, sort of quasi commodities or the process industries there. But I am looking at a slightly more restricted definition. So autos, more the four-wheelers than the two-wheelers, and some of the household goods. Those are, the kind of core focus that I have. So yeah, I mean, I think that's what the investors should look at. One should be careful in this sector about valuations also, because there is a wide range as far as valuations are concerned, particularly when it comes to growth adjusted valuations. If you look at the future earning growth over the next 2 to 3 years and juxtapose it to the price earnings or price to book multiples that these companies are trading at, that measure is actually what one should look at.
Yeah, just to follow up on that, since you've talked about autos and a few of them in focus, Maruti Suzuki, for example, had a bit of a soft quarter. Tata Motors has been under this pall of gloom, if you can call it that, because of Jaguar Land Rover and the implications of auto tariffs. So therefore, if anything, if I were to point out one company in the automotive pack where valuations have taken a real battering, that is Tata Motors. Where do you find comfort valuation-wise? What names are you looking at? And not recommendations, but what names are you studying closely?
I mean, I would definitely look at the market leaders in the domestic focused sectors, so then the names pretty much become obvious, right? Because we think that market leaders which have pricing power, they are the ones which would be able to weather the storm in a far more efficient manner. That is if in every sub segment of the auto industry, if one looks at the market leaders which have a significant moat, protecting their market share and their margins, then I think that's almost a surefire way to invest, to look at this sector.
Manishi, interesting point that you mentioned about, what's happening on the valuation front is what you need to consider as well. So far, with the companies that have already announced numbers from Nifty 50, would you say that it's weak corporate performance, or how would you, actually talk about it? And from here on, do you see further room for, valuation cut that could be coming in, which would then make your Indian markets much more attractive?
In fact, to both your questions, the answer would be yes. I would think that this particular quarter that we're right now in the midst of would not be too great. We have seen the large cap frontline IT companies. There's been a bit of a disappointment over there. We have seen some of the large consumer staples companies, which have also talked about a continued, not quite a slowdown, but kind of a pedestrian demand situation over there. Now, when we come to the big banks, that would be the real test. But on the whole, I would not be very positive about this particular quarter. I also think that this quarter, the Jan-March quarter being reported now, is possibly the worst. After that, some impact of the cash coming in the hands of consumers, some impact of government expenditure in infrastructure would begin to seep through into the economy and demand. So going forward, the April-June quarter, and particularly the July-September and the subsequent quarters should be better. Now, the valuation question is interesting because India was recently, if you go back to around mid-March or so, or early March, the Indian valuations relative to the Asian peers had actually come down to reasonably attractive levels. They have again shot up. So I would think that if the valuations do come down, and I would expect them to, sort of moderate a bit further, then that would be a more attractive opportunity for investors to enter.
Okay, so Manishi, I don't know if I should be asking you this. If you're seeing further pressure in terms of valuations that should be coming in, or the valuation should get richer, I would say. I don't know how to put that one for you, but if we are going to wait out for, valuations to come down further, what are the levels that you would be tracking in terms of Nifty? Because it's sporadic right now, right? So what is that fair perspective in terms of Nifty and Bank Nifty according to you?
Right. So, the way I tend to look at it is actually relative valuations. Relative to, let's say, the Asian peers, like the valuation of MSCI Asia ex Japan or any other large frontline index. On that perspective, India is currently at somewhere around 55 to 60% premium. The average premium, if you look at the last 15 years, is somewhere around 40 to 42%. So that means that if this premium comes down, suppose the Indian market declines somewhere around 8 to 10%, or if the Indian market stays pretty much where it is, but the other markets in Asia, and particularly the large markets in North Asia, move up significantly, I think that would be, possibly a more relevant way of looking at this.
Then let me ask you this. The reason why people are maybe ascribing that higher multiple as things stand right now is perhaps what CLSA said, which is the return of TINA. There is no alternative. In elevated uncertainty elsewhere, people are looking at a growth story in India. Even at a slower pace, you're talking about 6% growth. So do you think that therefore those higher multiples are warranted?
There's some merit to that argument, no doubt. Because we are seeing these tariff-related uncertainties, which are much higher in rest of Asia, and particularly more so in Southeast Asia and pockets of North Asia, like Korea and Taiwan. But at the same time, one has to sort of consider what is an appropriate premium. Is it 40%? Is it 50%? Or is it 60%? I would be more comfortable, especially with the current earnings growth profile, if it's really 12 to 14%, going forward in the foreseeable time horizon, and I'm playing about 20 times P multiple, I would be a little circumspect about jumping into the market right now. Um, Also, if we do see bilateral trade negotiations being actually, being put through and being successful over the next maybe 3 or 6 months, then some part, I mean, not all, but some part of this, tariff-related uncertainty could actually settle down. And therefore, the markets which are looking really suspect right now, they could again come back into.
Okay, I think we just lost Manishi right at the last moment, but the point that he was making is well taken. Manishi, thanks so much for joining in.